Welcome to the daily update, where I'll go over the action in the market for Monday, December 9th, and we'll see how things look for Tuesday, December 10th. Had a down day. We've been seeing some weakness starting to build into the market that carried through in Monday's session as far as price action. Now we have to see, okay, is this a pullback? Is this profit taking? Or is there more weakness that's developing? And you can make a case for either side. So we'll just evaluate this day by day. We're also coming into a period, at least for this week, of negative seasonality, where the market tends to be under pressure through the end of this week and into early next week. But the market's probably going to do something different. These are just historical averages of what has happened in the past, and we'll see if it matches up with what happens now. There's a thing called the SPX Investing Program. It's launched, it's up, it's going, it's free until the end of 2024. There are additional videos that I post there. If you want to learn more about the program, there's a link to a video as well as to the website. If you have any questions, you can email me. And one thing that members get, even at this free stage, is immediate access to the videos as soon as they are available. Also, the daily video is really the foundation of the analysis that I do. We just finished going through the weekend. I did all the weekend videos. Now we're back to focusing on the daily videos. And this is really where we see the incremental movements and things to watch out for that are either positive or negative that tend to flow through and have an impact on price. Sometimes they don't develop into anything, these little changes that we see. Other times they really do follow through. Okay, let's go back and talk about what happened and then look at some charts. We had a lower open. We immediately went down below S1. Now, the range for Friday was not very wide between the open, high, low, and close, so the pivot points were not all that far for Monday's session. But we got down below S1 at 60.80. That's kind of interesting. We stuck with round numbers here. We also got down below S2 at 60.70. Then we attempted to go back above S2, but then we declined to close slightly above S3 at 60.50. Kind of interesting how that worked. We were down 0.61% on above average volume, a little bit of a concern to see some selling and volume to pick up. Where last Friday, we didn't really have above average volume. We were actually below average volume, but we're still positive in the short, intermediate, and long term. We're seeing some of the weakness developing in the intermediate term, and now it's starting to bleed through into the short term. Right now, as I said, it just looks like a pullback, just normal backing and filling. We'll have to see. Are the buy the dip folks going to come in and be able to prop things back up, or is more weakness going to come into the market and even put that confidence that folks have when they do the buy the dip thing? Because what is a dip after all? Doesn't mean that the dip is over. If they're thrown into doubt and all of a sudden they're getting into a position thinking that they're getting in at a better price and all of a sudden they're losing and they get out, well, that kind of feeds on itself at times. But for right now, we are still positive. We're going to get some more inflation data this week with CPI and PPI coming out. A whole list of geopolitical things. My goodness. Uh, Regime change in Syria, which doesn't really have that much of an impact on the U.S. Of course, things going on in the Middle East additionally between Iran, Israel, Hezbollah, Hamas, things going on in France with their government, also things in South Korea. But the market, there was some news out of China that seems to be bumping their stocks up, that they're going to be adding some liquidity there and doing some shifting around that may help give a bit of a bump to Chinese stocks. And so the market is just kind of, okay, big deal. We've got all these things going on. We're going to deal with our own virtual reality here. And we did see a little bit of a pullback on Monday. We'll see if that follows through into anything more. Some comments. It was a broad-based decline that right now just appears to be a pullback. Nothing, we're not really shifting over and looking negative as of right now. That could change. That's why we step back at the end of every day and reevaluate things and say, okay, is the climate shifting over? Right now, no. We still have a non-confirmed Hindenburg Omen, and our list is really short now. With the short-term indicators that we're looking extreme positive, we only have the stochastics now. All the other things have dropped off the list. Intermediate term, also a pretty short list right now with the Sean trend meter, even though it's declining. We're still getting a high reading for the bullish percent index for the NASDAQ 100, but the extreme reading that we had for the S&P, that's now dropped off. And we'll see if there's going to be any other changes to the scenario. It does look like this rate cut coming up at the next FOMC meeting is going to happen, 25 basis points. The market seems to be locked into that. I went over that over the weekend, and unless we get some really crazy data with CPI and PPI, it looks like that will end up happening at their December 18th announcement. The dollar was up and interest rates were also up. We closed at 4.2% with the 10-year yield, where Friday we were at 4.15%. We're still inverted with the 10 to the 3 month. We're back still being uninverted with the 10 to the 2 year. Sentiment is right at neutral at 50, where we ticked down from 53. And we had been seeing that coming down even before we saw the decline in Monday's session on price. Sentiment was actually looking a little bit negative ahead of it, which usually sentiment follows what's already happened. And we're still positive though with our trend, and we're still in a trending environment with the ADX above its moving average, and the green line is on top, even though it is declining. Since we had a down day, the bias is negative, but the momentum over the last number of days continues to be positive. We just had wholesale inventories coming out for economic reports. They were up 0.2% month over month, which is what was expected. They were down 0.2% last time, and here is a chart. Not a real influential report. We just like to keep an eye on this because if there are a lot of inventories being built up, that means they're not going out the door. They're sitting on the shelves where they've been produced. And that just means there's not a lot of activity going on as far as sales. But we're not really seeing anything all that out of the ordinary currently. Then this was kind of interesting. You've got the 2025 year-end forecast, and there's even been some modifications to this since I took this screenshot. But with the market really going up and things looking pretty solid, the change in administration, of course, the whole world's on fire, but the stock market, everything is just hunky dory. You have these projections going out. Now, if we hit some bumpy times, these projections are just going to be lowered. Okay. When we're going up, the forecasts tend to look positive. When we're going down, the forecasts look negative. It's more human nature to do that. But coming in as somebody that I actually respect and I follow the website and I follow emails is Edward Yardeni. He thinks we're going to hit 7,000 at the end of 2025, as is Deutsche Bank. And then you can see the other folks along here and kind of have a high of 7,000 and a low of 6,400. There was somebody else that's coming in with a forecast, I think, of 7,100 that's not on this chart, which is actually a little bit higher. That's kind of interesting to see this. People love forecasts. I don't forecast. I look at where are we right now with the charts and then say, okay, things are looking positive, they're looking negative, and we just go with that. I don't try to project out as to what I think will actually happen. And here's another one where I have to blow up this smaller chart here. It says the huge November for small caps could just be the beginning. So when we have a really good month in November, which small caps had a pretty good month, we're up 66.7% of the time. A month later, 3 months, we're up 76.2. The best return is 6 months going out. We're up 90% of the time. And then we kind of drop down there when you go all the way out 1 year. Then the average cumulative S&P 500 total returns. This is if you just invested on any old day versus when we hit a new high, then what happens after that? And they tend to go pretty much hand in hand with each other, but investing at a new high, that's when you're buying into strength, and that tends to outperform in the longer term. Cross asset flows over the last 4 weeks. Where's all the money going? A lot of money going into money markets right now. We're seeing money coming out of bonds currently. and more money going into investment grades, more conservative corporate bonds, and money coming out of emerging markets, some going into high yield. That would be junk bonds. Then you have balance funds, the 60/40 kind of thing where you have stocks and bonds together. And then developing markets. This we're seeing a little bit of money going here, and we're seeing a little bit more money going back into emerging markets right now. And then looking at the bearish bets flop, this is the assets and leveraged long ETFs. These we sometimes refer to these as juiced ETFs, so like a 2-to-1 or a 3-to-1. They exceed inverse products by a record. Okay, and it just shows a lot of money is going in, and they it tends to follow what's happening. We've been going up, we've been setting all-time highs, so folks are getting into the bullish type of funds, where the bearish funds have not been performing all that well at all. And then the cumulative, this is kind of a strange thing, and it's a little counterintuitive here. This is a 25 cumulative return on S&P 500 over gold. When this is going down, that means the S&P is underperforming. And it says the 2000 to 24 has seen a very rare outperformance for gold. When this is going down, that means gold has been outperforming. And a lot of this, I remember when the GLD ETF, that's the gold ETF, came out. And right around that time, we used to have this other measurement for money, the money supply, that suddenly they just kind of did away with. And it was the broadest measure of the money supply. Gold was at about 400 at that point, and we really saw things take off. And there was additional popularity in the gold ETF. And even though gold has been really bumpy along the way, over the last 24 years or so, it has outperformed. That's really what this chart is trying to show. And then big tech valuations are on the rise. I go over this in the intermarket analysis video. Magnificent Seven average price to projected earnings ratio. It's getting really, really high right now. Just means the market could be considered overvalued. And then I did find a few charts here. This is the capitalization and showing how the US has so much more in capitalization than when you take Asia and Europe. You actually add them together and it doesn't equal what the US is. And that's why the US market is the most popular. And what may worry? Percent of investors who think that there's a less than 10% probability of a crash in the next 6 months. Not a lot of people are thinking that right now. Could be a little cause for concern. Of course, we're not perma bears, we're perma realists. At least I am. I try to be that way. But when the market really starts to exude this overconfidence, it has a tendency to do the opposite, at least enough to shake up folks. Then bearish bets flop. This is also showing how the assets are in the leverage funds. I think I already showed that, but it's a different looking chart here. Okay, and then this is a seasonal chart, but it's showing the ratio between small caps and large caps as measured by the Russell 2000, which are small caps, and the Russell 1000, which are the large caps. And coming into about the middle part of December, this is when we see the small caps really outperforming. Is that going to happen this year? Seasonally, it's happened. A lot of people are anticipating that happening, and it kind of happened a year ago, only to kind of fizzle out as we got our way further into 2024. Are we going to see more of a follow through this time? Okay, and then Fed Chairman, this is kind of interesting. Fed chairman projects soft landing for U.S. economy. Business International Herald Tribune. Look at the date here. I actually put the box around it. February 15th, 2007. Okay, this is right before the great financial crisis. And this is when Ben Bernanke was the chairman of the Fed. Oh, yeah, we're going to have a soft landing. No problem here. In fact, at that time, things were looking pretty good in 2007. The economy was doing quite well. The markets were doing really well, and then everything fell apart after that. So it just shows you how even the folks that are supposed to know what's going on don't always know what's going on. All right, let's go back and look at some charts here. We did have a lower open pretty much right out of the gate. We were going down, we dropped below S1, we quickly went down below S2. We tried to find some support in here and then bouncing up a little bit, but we just weren't able to get back above S2 with any conviction. And then this is when the smart money comes in and says, okay, we're selling today. We're going to take things all the way down and close just above S3. Here's the chart. Not really seeing much of a change in the initial overnight session, and things were pretty quiet when they opened Sunday afternoon or evening. It was pretty much during the cash session when we saw a lot of the movement take place. This is still encouraging. We still have the blue line above the red line, where that's showing on an intraday basis how growth is still outperforming value. This is still looking okay for the time being. We saw growth really getting hit hard earlier in the day, but it started to make a comeback, and that could be positive on this intraday chart when we look at S&P growth to value. End of day, we were down almost equal here with the growth to value ratio, but growth had been down a lot more. It was down more with the mid caps, and small cap value was up where small cap growth ended up being down. So we look at our end of day ratios here, coming down a little bit with small cap growth to value, but still has been showing some strength lately. And mid cap also coming down. We're just starting to generate a golden cross here with mid cap growth to value, looking at that ratio and coming down here, but still positive overall with S&P growth of value when we look at that ratio. So yeah, we saw some weakness here, but according to these charts, we're not really seeing much of a defensive shift, at least yet. We'll have to see how this continues to play out. And this really didn't get hit all that much at all. The growth versus value ETF here, it's been doing quite well. It was down slightly in Monday's session. Still looking okay here with discretionary to staples, with the ratio down on the bottom of this chart. Large cap growth setting an all-time high on Friday, backing off in Monday's session. So here's our trend. We are still positive, but the green line's coming down. The ADX is still above the moving average. Now, if we see more weakness here, that's going to cause the ADX to roll over even more and possibly drop below the moving average. We're just waiting to see if that will happen, but it hasn't developed yet. But we're still positive here, and we're still in a trending environment. And the short-term trend also rolling over a bit with the ADX. The green line's coming down, the red line's coming up. But right now, we're still in a positive short-term trend as well. And you can't really see it here, but we did go above average with volume, but we've been below average, but it's been increasing over the last few sessions with this oscillator. And here's our weekly chart. Now, we're neutral when we look at the sentiment gauges that we follow on a daily basis. We're still extreme here when we look at this composite sentiment gauge here coming in at 83.31. And really seeing this could put some pressure on stocks too. This is really going up. These are legal insider transactions, and we're seeing a lot of movement up here, which tends to be more bearish for the market. We're actually going down a little bit now with the insider buying ETF. It really hasn't been doing all that much. It's in an uptrend, but it's been chopping sideways for most of 2024. So we ticked back up with the down day with the VIX on a closing basis, looking at the line chart. We also went back up with the bar chart. And when the VIX goes up, the VIX of the VIX also goes up as well, as to be expected. This could start to show a shift here with the momentum of the VIX. The MACD is potentially getting ready to cross back above the moving average. Not quite there yet, but if we have another down day and the VIX goes up, we might see the momentum for the VIX shift to up. And this is what we see historically. I show this every day over the last month or so, just showing how we tend to go down with the VIX during this time of year, but it doesn't mean we're go straight down. There are going to be times when it bumps back up if we stick to this historical pattern and coming down. So when we look at the skew index, because when I look at this chart, I try to be neutral about it. It's just the market is expecting some kind of a big move. Well, as we were going up, this reading kept getting higher and higher and higher. Then we have a downward move, and this comes down. So maybe the big move that's being expected is more of a down move. We went up a little bit with this fear gauge down here. We also went back up with this other fear gauge. That's more of a confirmation of some fear coming back into the market. And I've been showing this over the last few videos as well. Even though we had a down day, we're still seeing the risk-on ratio continue to go up, where it had been chopping around sideways for quite some time. And this could be more positive. This could be some buying under the surface that's going on, especially with the big stocks. And we went up with the equity put call ratio on the down day. That's not a surprise. We're still going down with the 5-day chart, but we're Also getting to an extreme negative reading here, but we're ticking back up a little bit here with the 10-day chart. A little bit of a contradiction there. And we came down a little bit with the volatility risk premium. We saw a real big upthrust in Friday's session, only to back off a little bit. This is showing overall that there's been an increase of fear looking out 30 days into the future. So we're coming down a little bit, but still positive with the advanced decline line based on price and volume. But this is still holding up since we're above the advancing moving averages. And we actually saw more new highs than new lows, although we're dropping off with the new highs. So we're rolling back over with the 5-day, and we're already continuing to go down with the 10-day. And this is still positive, but showing some potential weakness here. We're coming down with accumulation distribution, getting closer to the moving average. That's why this indicator down below, the boom indicator, is now declining. And we're actually dropping below zero with the advanced decline ratio. That's the blue line. That's short term. And we're declining, but still positive with the intermediate term advanced decline ratio. This is another concern, another smart money indicator coming down with the histogram. And the red line is going down. This is actually turning more negative until proven otherwise. And we're also declining with the Chaikin oscillator, our third smart money indicator, which continues to decline. Now, we're still positive since we're above zero, but the context right now is that this is going down. And after seeing a real big improvement after Friday, we're coming back down with the vortex, with the green line coming down. A little bit of an uptick here with the red line. And the cumulative advanced decline line for the S&P coming down here based on price and volume. And kind of seeing a bit of a disconnect, but now they're going more hand in hand. When we look at the S&P, where it had been going up with the advanced decline line for the NYC going down, we were pretty much flat here, where we did see a decline with the S&P. And this is actually a little bit positive for the broader market. The cumulative advanced decline line actually went up a little bit, but we're still going down with the regular NYC advanced decline line. We're also declining with this NYC advanced decline line, but still above the moving average. When we break it out for the NYC common stock based on price, we were flat. We actually ticked up just a little bit here based on volume. That could be some buying into weakness. The advanced decline line still showing some weakness here, but looking positive overall. We're still above the moving average with the NYC common stock, still above the moving average with the S&P, right at the moving average with the mid caps, and flat to even up a little bit with the small caps. Still below zero with the stocks in the S&P 500 below or above their 20-day moving average is continuing to drop below 50. And we're turning back up. This is one of those internal things that we saw on Monday, even with the down day. We ticked back up a little bit with those stocks above their 50-day moving average. The 100 is still declining, but we ticked back up a little bit with those stocks above their 200-day moving average, even on a down day. That could be some under the surface strength. We'll have to see if it can follow through based on price. So coming down off of this recent all-time high that was set on Friday, and we did see a pickup in volume on a down day. We're still declining with the 20 period and 50 period, but we actually ticked up with the 200 period moving average on the S&P itself. And after being extreme here and looking quite positive, the Stochk RSI is now dropping down below its midpoint. We're declining and no longer extreme with the Williams percent R. The CCI 14 is now dropping, and the CCI 20. These were all extreme positive pretty much for all of last week. That's been worn off pretty quickly here. Coming down in the short term, but still extreme with our stochastics chart, rolling over in the intermediate term, starting to roll over a little bit in the long term. But all three of these charts are extreme positive still. The force index did decline below the midpoint, but it's still green. And we're dropping a little bit below both the blue line and the green line here with the condition of the 20 period or short-term moving average. But when we look at the simple and exponential moving averages, we still have a ways to go. We'd have to drop, right now anyway, we'd have to go down below 6,000 for us to even get to that moving average. And we had been extreme for a few days here with the standard deviations chart. We were up in the +3 channel. Now we've dropped down into the +2 channel. So we've worked off that extreme reading too. Balance of power is declining here after getting extreme, but still well above zero. And we're kind of right in between here with the condition of our intermediate term trend. We're below the red line, but still above the blue line. The go no go is still positive with the darker blue bar. We're still coming off of the highest high reading here and above the an advancing midpoint. That's positive. We're actually looking a little more negative with the TTM squeeze. For a couple of days, it shifted, actually just one day, it shifted back to being light blue. When it turns to darker blue, that's more negative. Ease of movement declined a little bit, but still above zero. The Arun is pretty much flat after Friday's reading. And this is another thing that we've been watching. We've been below zero with the S&P McClellan oscillator, even before we saw that played out in Monday's session. This is still continuing to decline. So we are declining with the summation index based on price and volume. We're also still below zero with the NYSE McClellan oscillator. So we're starting to decline a little bit more here with the summation index based on price and volume. Still looking more negative this way with the Swenlin trading oscillator. We're going down and below zero based on price as well as volume. The momentum rolling over just a little bit, but still positive. It's when we break it out based on price and volume. This is when it's starting to turn more negative since they're dropping below their moving averages. But you look at the PMOs that are rising, actually ticked up a little bit. The buy signals are still declining, and we're still declining with the PMOs that are above zero. But to see a few PMOs actually tick back up, nothing really to hang on right now, but it's showing that there's still some positive action under the surface. The slope oscillator continues to look more positive now, and we're rolling over a little bit with the MACD, but still above the moving average. So we're pretty much positive across the board here in the short, intermediate, and long term with our momentum oscillators. We're still neutral with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR. And dropping down from this extreme reading with the Sean trend meter and coming down after giving an extreme reading with the money flow, also declining but still above 50 with the ultimate oscillator, ticking down since we had a down day, but still above the advancing moving average when we look at on balance volume. Still positive here with the Copic curve after crossing above its moving average, still working off of that, I guess, buy signal here from the Pring bottom fissure and coming down a little bit, but still above 50 with the intermediate term RSI. We did get an extreme positive reading after Friday with the short term RSI. That has now dropped down. Still above all the moving averages here. We still have a ways to go, even to get to the 20 period moving averages. And we were getting kind of far away from the 20 and the 50. Well, with the decline that we saw on Monday, we're now dropping back down here with the 20 and 50 boom indicator study. Still looking pretty good here with the 200-day moving average study. And coming down and dropping below 70 with the bullish percent index after giving us a reading above 70 would suggest good momentum. But this is showing that the context is turning a little bit more negative now. But we're still looking good with the NASDAQ 100 bullish percent index. It actually ticked up a little bit, but coming down here with the NYSE bullish percent index. Still wondering if this long-term trend line here, going back to 2009, is providing some kind of overhead resistance for the S&P. And looking a little more negative with the Heiken Ashi, where we have the black candle, at least as of right now. We're positive here with the Kegi. It's still black, but now pointing down. The Renko chart is still positive with the open blocks, and we're still positive with the three-line break. So getting a little bit of a mixed picture here. Nothing really long-term. We're just kind of duking it out in the short term right now. And I don't know if there's been any changes to this or not. They haven't updated it on the website. So we're still looking positive across the board with the Keller market model. I understand David Keller's not with stockcharts.com anymore, and he developed this. So I don't know if somebody else got delegated that. And this is also part of the Keller market model too. I'm not quite sure if there should be some kind of an update here. It hasn't changed in about a week. So we saw healthcare and real estate. Now, healthcare is a more defensive area. It ended up being up, and real estate's been just under a lot of pressure lately. All the other sectors ended up being down with communication leading the way lower. And we saw some green or blue to start the day with communication giving us a BPI across 70. NASDAQ setting an all-time high, Canada an all-time high. And then we turned more negative as the day unfolded We had a BPI cross below 70 with real estate. This is the BPI cross below 70 with the S&P, which I just showed. The BPI crossed below 70 with industrials. We had the NASDAQ dropping below 19.8, and then near the end of the day, it got back above 19.8. And then intraday, this is strange, the S&P sets a new all-time high. Huh? That doesn't seem all that legitimate. We were down. Okay. And we look at the weighted versus the equal weighted version of the S&P. They're both declining now. We were seeing a bit of a disconnect as the S&P was going up while the equal weight was going down. They're both going down now. The Dow dropping off after setting a recent all-time high and has actually turned to negative with the Elder's Impulse system. The Nasdaq still hanging out above this R1 pivot point. We're wondering if that will provide support. And just a little bit below this pivot point here with the Nasdaq 100. And going from positive to neutral with the Qs when looking at the Elder's Impulse system, the momentum for the Nasdaq 100 is still positive. And we were down 0.25% with the small caps. So all this love that's supposed to be coming in is not showing up, at least yet. And they were up earlier in the day, but then they ended up giving all those gains back and actually closing down at the low for the session. So they've gone from neutral to negative here with the Elder's Impulse system. And we're turning negative here with the mid caps. The mid caps are also trailing off right now. And here's the other Russell 2000 small cap index, dropping but still above 50 with the RSI, but the momentum in the short term is now turned to negative. The Wilshire dropping back a little bit after setting an all-time high last week and also pulling back after an all-time high last week as well. Financial sector still seeing a little bit more weakness here, a little bit more than just your usual profit taking. We'll keep an eye on this. The FANG index set an all-time high on Friday and then pulled back almost 1% in Monday's session. So we're wondering about this short-term trend line. We can't seem to get above that right now, and now we're starting to pull back a bit. Apple ended up being up 1.61%, setting an all-time high there. Amazon was down slightly, but still looking pretty solid. Microsoft was up over 0.5%, still has a ways to go to get back to an all-time high there. Google was up 0.5%, holding up fairly well with that. Meta was down 1.64%, coming off of a recent all-time high. Nvidia was down 2.55%, coming back down to its 50-day moving average. Tesla was up 0.15%, which is virtually unchanged, but still looking pretty solid there. Netflix must have had a bad weekend of movies, down 2.25% here. I actually watched a very interesting documentary type series on Winston Churchill that, if you're into history, might be worth your time. And it was on Netflix. Okay, semiconductors. We're watching this, and this is a concern to us. We're still below the 50 and 200-day moving averages, and we're seeing the 50, the blue line, crossing more below the 200. That's a death cross here, and we just can't seem to get back above this. This is a huge part of the market, and we've really been keeping an eye on this. Then this is another newer chart. I've had it around for a while, but I decided to start showing it here. This is a ratio of the semiconductors to tech. Earlier in 2024, the semiconductors were really outperforming, and that's when the market just kept screaming higher and higher. Well, then we hit that top over the summer, and now the semis have been underperforming. This is a concern to us. We want the semis to outperform because they're such a big part of the overall tech sector. This might end up putting some pressure on the market. So we just want to keep an eye on this ratio as well. Still seeing an improvement in the short and long term with the correlation between U.S. stocks and international stocks. Oil went back up here. Not sure if that was more of a reaction to what's going on in Syria, but it had been going down lately and saw a bit of a bounce on Monday. The dollar still showing more of an uptrend and was up in Monday's session. And we were up a little bit here with the 10-year yield. We're potentially seeing a cross here with the 50 going above the 200. If this goes up, that would mean that we're getting into an uptrend as far as interest rates are concerned. Then we look at it based on price. We still have a ways to go before we see some kind of a cross here. We were down with the 10-year based on price. And we're still looking pretty good here with the Qs to S&P ratio looking solid. Discretionary to S&P looking pretty good. Large cap growth is still looking good when compared to large cap value. So the large caps, mid caps, and small caps seeing a little bit of a pullback here, but still looking pretty solid. And we're going up again here with the S&P to utilities ratio. When this is going up, that means the S&P is outperforming utilities, and that's more positive for the S&P. And it's not that the S&P was up on Monday, it's that utilities were down more. That's caused this ratio to go up. So what's our outlook for Tuesday? The European Central Bank will be meeting on Thursday. Now the Fed's going to be week after, but sometimes we like to keep an eye on this just in case Europe does something crazy. I mean, they've never done anything crazy ever before. Why should they start now? But we still want to watch. Yes, I'm being sarcastic there. We're still positive with a bigger picture look at positive seasonality, even though we have some weaker seasonality for this week. We don't know if we're going to stick to that or not. It's just used as a guide, and we are still seeing some weakness developing in our more internal type measures that look at the intermediate term time frame. We're going to get the NFIB small business optimism as well as productivity and unit labor costs in Tuesday's session, and then all the crazy stuff going on geopolitically to see if it has an impact on the markets. On Wednesday is going to be CPI. On Thursday is going to be PPI. Plus, we'll get our usual weekly jobless information coming out. Here's another look at the chart. Really, the only big things will start in Wednesday's session. Seasonally, we're neutral to negative with the Dow, where we're neutral to positive with the S&P and Nasdaq going back to 2002. This is the seasonality that I've been talking about, where it possibly could have carried over into Monday's session. It didn't. So that's kind of gone for right now. And this is the weak seasonality that we're seeing going into the early part of next week. Again, we don't know if it's going to play out that way, but we just want to be aware of this anyway. Tuesday is a flip of the coin if you look at 2023, and it's the least positive day so far in 2024. I finally got this updated here. This is Tom Bowley's research, where December is a very bullish month overall. You have staples that are not very hot, and you have real estate. What do they give houses for Christmas? I don't know. But it tends to be a better area. Well, the first part of December, which we're now past, that's the upward part. Now we're coming into the weaker part. It could last for a little while before we go into an even stronger part. Then it's like right before Christmas, we have to have a little bit of Grinch showing up before we have the week between Christmas and New Year's showing some positive action here. Okay, the warning signs, and we're out of sync here. The 10-day equity put call ratio chart is going up. We're still going down with the NYSE as well as S&P McClellan oscillators and summation indexes. We still have a non-confirmed Hindenburg-Ullman, and the Swenlin trading oscillator is still negative. And our 20-period moving average study, we're still below 50 there, so that has turned negative as well. And we're still positive here, but we're showing a lot of weakness with our three smart money indicators, actually starting to go down with the Chaikin money flow and Chaikin oscillator, still above the moving average with accumulation and distribution. Now we have another down day. This is probably going to get shifted over to the negative side or the slide that you just saw. We're still going down with the 5-day equity put call chart. The vortex is positive, even though the green line came down. We're still looking okay with our growth to value and discretionary to staples ratios. And our oscillators are still positive right now. And we've actually turned back to positive with the slope oscillator as well. The Copic curve is positive. The advanced decline lines are positive, but have been showing some weakness there. We're still looking positive with the 50, 100, and 200-day moving average studies. It's the 20 period that has actually turned negative by dropping below 50. Parabolic SAR is positive. We're still looking extreme with the NASDAQ 100 bullish percent index. We're no longer extreme, but now we're starting to go down with the S&P and the NYSE bullish percent index. Ease of movement, money flow, and ultimate oscillator showing some weakness, but still positive. And the momentum for the NASDAQ 100 continues to be positive, and we're still seeing some more follow-through weakness with the financial sector, but it's still positive. Okay, and then just an update of the Hindenburg-Ullman chart here. No new confirmation of another spike, at least yet. So our conclusion, we are still positive, bigger picture positive seasonality, but we are continuing to see weakness developing here. And we are positive where I should have probably changed this over to negative seasonality, at least for this week anyway. Intermediate term, we are still positive, but this is where we're seeing some of our indicators actually show some weakness. We continue to be positive in the long term. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.